Inflation. It's a term we often hear in the world of economics. But what exactly does it mean? At its core, inflation refers to the rate at which the general level of prices for goods and services rises, resulting in a decrease in the purchasing power of money. Imagine this. 50 years ago, a loaf of bread might have cost just a few cents. Today, that same loaf could cost several dollars. The reason? Inflation. There are numerous factors that can cause inflation. It might be due to increased production costs, a rise in demand, or even an increase in the supply of money. While moderate inflation is considered normal in growing economies, high inflation can erode savings and purchasing power, making it harder for people to afford basic necessities. Understanding inflation is crucial, as it affects everyone, from the individual consumer to the global investor. Stay informed and be prepared. First, there's hyperinflation. This is an extreme form where prices rise more than 50% per month. Historically rare, hyperinflation is often caused by a collapse in the supply of goods combined with an oversupply of money. Then there's stagflation, a tricky scenario. Stagflation combines stagnant economic growth, high unemployment, and rising prices. It's a challenge to address, as traditional economic tools often only solve one part of the problem at the expense of another. Next, we have creeping inflation. This is when prices rise at a steady pace, usually between 1 to 3% annually. It's considered normal and even beneficial for economies in moderation. Then there's walking inflation, where prices rise between 3% to 10% in a year. Here, economies need to be watchful, as it may indicate an overheated economy. Lastly, galloping inflation. This is when prices skyrocket, but haven't yet reached hyperinflation levels. It's characterized by a rise of over 10%, potentially even reaching several 100% annually. Understanding these types helps policymakers craft strategies to maintain economic stability. For us, it offers insights into the financial forces shaping our world. From ancient civilizations to today's digital age, the concept of inflation isn't new. Historically, empires like Rome faced inflation when they minted coins with less precious metal, effectively devaluing their currency. Meanwhile, in the medieval era, inflation reared its head in response to wars, plagues, and harvests. Fast forward to the 20th century. The world wars and global events radically impacted economies. In post-WWII Hungary, hyperinflation reached such an extent that prices doubled every 15 hours. In contemporary times, inflation remains a crucial economic indicator. Central banks, like the Federal Reserve, often aim for stable and predictable inflation, believing it's essential for economic health. The significance: inflation influences everything, from individual purchasing power, savings, to global investment strategies. Its historical lessons remind us of the delicate balance economies must strike. Understanding inflation's rich history isn't just a look into the past, but a roadmap for the future, guiding decisions and shaping economic fates. Inflation erodes purchasing power, impacting economies and citizens. While signifying growth, unchecked rates destabilize markets. Individuals face strained budgets, especially those on fixed incomes, highlighting the need for economic balance. Imagine a bustling market where everyone wants the same product. As the crowd grows, the product becomes rarer. This is the essence of demand-pull inflation. When the demand for a product or service outstrips its supply, prices naturally surge. Such inflation is often sparked by increased consumer confidence or significant inflows of cash into an economy, like tax cuts or increased government spending. Producers scramble, trying to meet the demand. But when they can't produce fast enough, or when resources are limited, the supply remains constrained. As more money chases fewer goods, the prices inflate. This isn't just limited to tangible products. Services, real estate, and even experiences can see price hikes. For economies, understanding and managing demand-pull inflation is crucial. Left unchecked, it can spiral, leading to broader economic imbalances. In the delicate dance of demand and supply, balance is everything. Every product we use has a journey before it reaches us. But what happens when that journey becomes pricier? Cost-push inflation arises when the costs to produce goods and services increase. This could be due to pricier raw materials, increased wages, or even a scarcity of resources. When production costs climb, producers face a dilemma: absorb the costs and take a hit on profits or pass them on to consumers. Often, the choice becomes inevitable. To stay profitable, producers increase the price of their goods and services. And this, dear consumer, is felt directly in our wallets. Cost-push inflation can snowball. As prices rise, workers demand higher wages, further inflating production costs. It's a chain reaction with potential repercussions on an entire economy. For nations, understanding and mitigating cost-push inflation is essential. In the balancing act of production costs and consumer prices, stability ensures an economy's health. Built-in inflation. The wage price spiral. Time, they say, is a great revealer. And in the world of economics, built-in inflation reveals a captivating dance between wages and prices. Imagine a scenario. Prices rise due to various economic factors. It's a situation we've seen right now. Workers, facing these rising costs of living, naturally demand higher wages. Employers might concede, but there's a catch. To afford these higher wages, businesses might then raise their product prices even further. This leads to even higher costs for consumers. So begins a cycle. Higher wages lead to higher prices, which then lead to demands for even higher wages. This is the wage price spiral, a core component of built-in inflation. Unchecked, this spiral can perpetuate inflation in an economy. The challenge: finding equilibrium, where workers are fairly compensated without driving uncontrollable price hikes. External events leading to inflation. In our interconnected world, events halfway across the globe can ripple into our daily lives, influencing economies and pocketbooks. Take oil, the lifeblood of modern economies, from powering our cars to manufacturing goods. Now, imagine a disruption: political unrest, natural disasters, or policy changes in major oil-producing regions. Such external shocks can lead to supply shortages. And with oil being so foundational, reduced supply and increased price affect everything. Rising transportation costs make products more expensive to produce and deliver, leading to higher prices. Every day, we buy a myriad of goods and services, from the morning coffee to the smartphone in our pockets. But have you ever wondered how we measure the average change in prices of these items over time? Enter the Consumer Price Index, or CPI. This statistical tool offers a snapshot, reflecting the average change over time in prices paid by urban consumers for a basket of goods and services. Imagine a virtual shopping basket filled with items that a typical household might purchase. The CPI tracks the price changes of items in this basket over time. Used by economists, policymakers, and researchers, the CPI helps determine the health of an economy, indicating periods of inflation or deflation. In essence, the CPI is more than just numbers. It's a lens providing insights into our economic well-being, influencing key financial and policy decisions. In the vast expanse of economic landscapes, before products reach consumers, they undergo a journey of creation and value addition. But how do we gauge the change in the selling prices at this production level before it touches the consumer market? This is where the Producer Price Index, or PI, comes into play. It measures the average change over time in the selling prices received by domestic producers for their output. Unlike the Consumer Price Index, which focuses on the end user, PI delves deeper, capturing price changes from the perspective of the producer. Its significance: the PI can serve as an early indicator of inflationary pressures. If producers face rising costs, they might pass these on, affecting consumer prices down the line. For policymakers, businesses, and investors, understanding PPI trends is invaluable. It aids in decision-making, investment strategies, and gauging the broader economic climate. In essence, the PI is a crucial cog in the machinery of economic insight, linking production costs to our daily financial realities. In the economic heartbeat of a nation, one key metric stands out: the inflation rate. It's the rate at which the general price level of goods and services rises over time, eroding our purchasing power. But how do we calculate this rate? It's simpler than it might seem. We subtract the consumer price index of the previous year from that of the current year. This difference is then divided by the CPI of the previous year, and finally multiplied by 100 to get a percentage. This resulting percentage reveals whether we're experiencing inflation, deflation, or stable prices. For consumers, investors, and policymakers, understanding the inflation rate is paramount. It shapes financial decisions, monetary policies, and even our daily spending habits. The inflation rate isn't just a number, it's a reflection of economic health and the evolving value of our money. Amidst the ever-evolving tapestry of economics, there's a concept as fundamental as the marketplace itself: the basket of goods. Imagine a basket, not just any basket, but one that contains items most of us buy regularly, like food, clothing, transportation, and entertainment. Each item has its own price, and these prices can change, reflecting the ebb and flow of the economy. Now, what if we were to calculate the total cost of this basket over various points in time? Differences would emerge, painting a picture of our economy's price movements. And this, in essence, is how inflation is gauged. Savings, a cornerstone of financial security, allowing us to plan for future dreams and emergencies. But as time moves forward, there's an invisible force that can erode the value of every coin saved: inflation. Inflation is the rate at which the general level of prices rises, and as it climbs, our purchasing power, the real value of money in terms of what it can buy, declines. Think of it this way: if your savings don't grow at a rate that outpaces inflation, over time, you'll find that your money buys less than it once did. Simply putting money under your mattress or in a low-interest account can mean losing out in the long run. The real value of your savings diminishes. For households, this means harder choices, prioritizing needs over wants as essentials become costlier. In essence, understanding inflation's impact on savings and purchasing power is crucial. It influences our financial planning, ensuring we strategize not just for the present, but also for an unpredictable future. In the intricate dance of economics, two key performers often take center stage: inflation and unemployment. For decades, economists observed a curious pattern. When unemployment was high, inflation seemed low, and vice versa. This observation led economist A.W. Phillips to chart what became known as the Phillips curve, suggesting an inverse relationship between inflation and unemployment. But like old dances, the steps aren't always predictable. The 1970s saw both high inflation and high unemployment, challenging the conventional understanding of the Phillips curve. While not a steadfast rule, the Phillips curve provides a lens to view the tension between job markets and price levels. Policymakers often grapple with this, balancing the desire for low unemployment with the need to keep inflation in check. In the grand choreography of economics, understanding the interplay between inflation and unemployment remains paramount, guiding strategies that shape the well-being of nations. In the world of finance, few things are as interconnected as inflation and interest rates. Like a seesaw, when one rises, the other often follows. But why? Central banks, tasked with stabilizing economies, adjust interest rates to manage inflation. As inflation rises, central banks often hike interest rates. The rationale: higher interest rates typically lead to decreased spending and borrowing, cooling down the economy and curbing inflation. For consumers and businesses, higher interest rates mean more expensive loans. That dream home or ambitious business expansion, they might need to wait. Conversely, when inflation is low and economies need a boost, central banks might lower interest rates, spurring spending and lending. The dance between inflation, interest rates, and lending is a delicate balance. Recognizing their interplay is key to navigating financial waters. Whether you're a policymaker, a business, or an individual with dreams to finance, inflation and economic storm can pose challenges for businesses, altering the calm seas of predictable costs and revenues. As raw material prices soar, production costs escalate. To stay afloat, businesses employ multiple strategies. Some streamline operations, improving efficiency and reducing wastage. Others diversify their offerings, tapping into less affected markets. Inflation challenges strategy and adaptability lead to strength. We've all heard of inflation, but what happens when it runs wild? Enter hyperinflation. Hyperinflation isn't just high inflation. It's an extreme and rapid acceleration where prices can double in a very short time, often monthly or even daily. History has grim tales. Citizens needing wheelbarrows of money to buy basic goods, savings wiped out overnight. Trust erodes. The value of a nation's currency plummets, and uncertainty reigns. Countries like Zimbabwe and post-World War I Germany have felt its harrowing grip. Understanding hyperinflation is crucial, not just for economists, but for everyone. It underscores the vital role of economic stability and trust. History has seen the devastating dance of hyperinflation more than once. Post-World War I Germany, the Weimar Republic, faced an economic catastrophe. Bills skyrocketed. Citizens carried bundles of banknotes just to buy bread. Fast forward to Zimbabwe in the 2000s. The once prosperous nation grappled with dizzying price increases. Trillion-dollar notes became commonplace, but still couldn't buy basic necessities. And then there's Venezuela, rich in oil, but plagued by economic mismanagement. The bolivar's value plummeted. Everyday items became unattainable luxuries. These cautionary tales remind us of the fragility of economic systems. Through understanding their stories, we grasp the paramount importance of economic foresight and sound policies. Hyperinflation. It's more than just rising prices. But what fuels this economic firestorm? Often, it's a mix of external shocks like wars and sanctions, combined with internal strife and poor economic policies. Government overprinting of money without backing can ignite the spark. The consequences, devastating. Prices soar unpredictably. Basic necessities become luxuries. Life savings evaporate, making future planning near impossible. Businesses, unable to predict costs, often shutter. Unemployment rises. Hyperinflation isn't just an economic term. It's a societal tragedy, a testament to the delicate balance of trust and policy in our financial systems. Hyperinflation's grip can seem unbreakable. Yet, nations have found ways to rise from its ashes. Central banks often increase interest rates, making borrowing costlier, thereby reducing excessive spending and money circulation. Currency reforms become pivotal. Some nations introduce new currencies, often pegged to stable foreign ones, to restore confidence. International aid and financial packages also come into play, helping stabilize the economy. Strategic partnerships and trade agreements can boost economic prospects, allowing nations to tap into global markets. In the face of hyperinflation, adaptability, global collaboration, and robust policy measures are a nation's best allies, guiding them towards stability and prosperity. When prices rise, we call it inflation. But what about when they fall? Enter deflation, a sustained decrease in the general level of prices in an economy. While it might seem like a boon, after all, who doesn't love lower prices? Sustained deflation can have troubling implications. If consumers expect prices to drop further, they delay purchases, leading to a reduction in production and often rising unemployment. Banks face higher real interest rates, discouraging borrowing and investment. Like its counterpart, inflation, understanding deflation is key to grasping the delicate balance of economic health. In economics, it's all about balance and timing. While falling prices might seem appealing, understanding why they drop is essential. One key driver: reduced consumer spending. When people tighten their belts, demand plummets, and prices often follow. Technological advancements also play a role. As industries innovate, producing goods can become cheaper. This cost saving can result in lower prices. Import surges, too, can flood a market with cheaper goods, pressuring local producers to slash prices. Government policies, like reduced public spending or high interest rates, might inadvertently curtail spending, ushering in deflation. Deflation is multifaceted, a mix of consumer behavior, technological progress, and policy choices. Its ripple effects touch every corner of an economy. Why deflation can be concerning for economies? Deflation, the fall in prices, might seem like a windfall. But is it? Initial joy can turn to uncertainty. If consumers expect prices to drop further, they wait, delaying purchases. This can lead to a vicious cycle. Reduced demand causes businesses to cut production, leading to layoffs. With falling prices, the real value of debt increases. Both businesses and consumers can struggle to repay loans, putting immense strain on banks. An economy can stagnate. Growth becomes elusive, and economic vitality dims. Deflation, for all its initial allure, can transform into a complex economic quagmire. It's a challenge nations strive to understand and navigate. Deflation isn't just a modern concern. History has borne witness to its profound effects. The Great Depression of the 1930s is perhaps the most infamous deflationary episode. Plummeting prices combined with bank failures led to unparalleled economic despair. Japan's lost decade in the 1990s was another. A bursting asset bubble triggered prolonged deflation, stalling growth for years. The 19th century U.S. faced agricultural deflation. Technological advancements made farming efficient, but dropped produce prices, straining farmers. Through the ages, deflation's recurring theme is its capacity to stall growth and deepen economic woes. Yet, each episode teaches lessons, guiding future economic strategies. In the realm of economics, central banks stand as sentinels, guarding against inflation's excesses. But what exactly is their objective in this battle? At the core, central banks aim to maintain price stability, ensuring that inflation remains predictable and under control. By adjusting interest rates, they can either cool down an overheating economy or stimulate one that's lagging. Managing the money supply, they can expand or contract the amount of currency in circulation, influencing inflation directly. Guided by data, these institutions set targets, often a specific inflation rate, and deploy tools to achieve them. In essence, central banks are the fine-tuners of economic harmony, ensuring inflation doesn't undermine an economy's song. Like skilled craftsmen, central banks possess a toolbox, each instrument honed for precise economic adjustments. First, open market operations. By buying or selling government securities, central banks control the money flowing in the economy. Then come reserve requirements. By dictating how much banks must hold in reserve, central banks influence their lending capabilities. The discount rate is another lever. Setting the rate at which banks can borrow from the central bank can stimulate or stymie lending. Currency interventions, too, play a role. By buying or selling their own currency, central banks affect its value and trade balances. Each tool, unique in function but united in purpose, to maintain economic stability and growth. In the vast ocean of economics, how do central banks navigate? Enter the inflation target. Inflation targeting is the practice of central banks setting and announcing a specific desired inflation rate, serving as a guide for their monetary policy. Just as we aim for a comfortable room temperature, central banks aim for an inflation level that ensures steady growth without overheating the economy. By communicating this target, central banks provide transparency and predictability, boosting public and market confidence. When inflation hovers around the target, it indicates a healthy, well-balanced economy, fostering stable prices and encouraging investment. In essence, the inflation target is the North Star for central banks, guiding economies towards prosperous shores. Throughout history, central banks have stepped into economic maelstroms, often with transformative effects. Recall 2008. As financial turmoil engulfed the world, the U.S. Federal Reserve slashed interest rates and introduced quantitative easing, stabilizing the economy and averting a deeper recession. Japan, grappling with deflation in the 2000s, adopted negative interest rates, spurring lending and investment. The European Central Bank, during the Eurozone crisis, declared they'd do whatever it takes to preserve the euro, restoring market confidence. Each intervention, tailored to its crisis, proved pivotal in steering economies away from potential calamity. Indeed, when central banks act decisively, they can transform economic landscapes, guiding them towards brighter tomorrows. As our world has become more interconnected, The tango between globalization and inflation has grown ever intricate. Globalization, the interweaving of economies, has brought us cheaper goods from afar, often putting a downward pressure on prices. Technological breakthroughs, the cornerstone of globalization, further reduced production costs, often curbing inflationary pressures. Yet, the coin has another side. With tightly knit economies, a hiccup in one region can ripple globally, influencing commodity prices and, by extension, inflation. Take oil. A price surge in one nation can lead to inflationary waves in countries dependent on imports. In this globalized era, the balance of inflation is delicately poised, influenced by a web of international ties, proving our world's interdependence. Inflation's tail varies across the globe, especially when contrasting developed and developing nations. In developed nations, institutions are robust, monetary policies well established. Inflation here is often moderate and stable, influenced by factors like technological advancements and wage growth. Contrastingly, developing nations face varied inflationary pressures. Rapid urbanization, external debts, and sometimes even political instability can lead to volatile inflation. Supply-side constraints, like infrastructural challenges and higher food and fuel dependencies, often amplify inflationary trends in these nations. While both face inflationary challenges, the sources and solutions differ, emphasizing the diverse economic landscapes they tread. As digital currencies vault to prominence, their shadow over traditional financial landscapes deepens, particularly concerning inflation. These decentralized assets, free from governmental oversight, beckon a new era of commerce. Their value, driven by demand, supply, and sentiment, can oscillate dramatically. Central banks, the traditional gatekeepers of money supply, find themselves in uncharted waters. Digital currencies, being decentralized, evade their conventional monetary tools. Some argue that widespread adoption could push prices down due to a fixed digital currency supply, contrasting traditional fiat's often inflationary nature. The confluence of digital currency and inflation paints an intricate picture. As this digital tide rises, economies worldwide must brace for waves of change. As the world speeds towards an uncertain future, predicting inflation's trajectory becomes a task akin to gazing into a crystal ball. Rapid technological advancements and the burgeoning realm of digital currencies suggest a potential for new inflationary pressures, or even deflationary trends. Environmental challenges, from climate catastrophes to resource scarcities, could disrupt supply chains, influencing inflation from a different angle. Then there's the balance of automation and burgeoning global populations. Will they drive prices up or down? While predictions vary, one thing's certain: in a rapidly changing world, inflation's tale is yet to be fully written, and its chapters promise to be compelling. If you found value in this deep dive into the complexities of inflation, consider supporting our channel. Your engagement pushes us to create more insightful content. So, if you haven't already, hit that subscribe button and join us in our journey to decode the vast realm of economics and beyond. Together, let's explore, learn, and grow. Inflation isn't just a term in economics textbooks. It's a force that molds the contours of economies, impacts our savings, dictates monetary policies, and influences global financial decisions. Throughout this series, we've traversed the intricacies of inflation, from its fundamental definitions to its deep-seated effects in both developed and developing economies. We've explored how inflation, when unchecked, can spiral into hyperinflation, causing economic chaos. On the flip side, we've seen how deflation, the decrease in prices, carries its own set of challenges. Modern times present unique considerations with global trade, technological advancements, and even the rise of digital currencies playing pivotal roles in shaping inflationary trends. As we stand at the precipice of financial evolutions, understanding inflation becomes paramount, not just for economists, but for every individual. Bye and have a nice day.